Hey everyone, as we've been talking about, this is episode number 3 with Matt Hawkins from the East Coast. How you doing, buddy?
Doing great, Mike. Doing great.
All right, so this week we're doing, everybody's talking about what happens, negative surprises. So we've done 2 already. Number 3 is, I don't know, probably the one that could be out there that kind of already is happening. And that is, what happens if interest rates jump from, let's call it 3% to 6%? And let's say they jump in a month, right?
Wow.
What happens to the market? You know, if the 30-year now is 6%, what do you think happens?
Oh man, what doesn't happen if that happens? Everything stops. Literally everything stops.
Yeah,
Because now no deal at the current pricing will work.
exactly.
If you're already battling a 4.5% cap rate, dear Lord. If you're already battling a 4.5 or 5% cap rate, and all of a sudden, your interest rate is double.
Yeah.
Yeah. Well, it doesn't make much sense anymore. And like we always talk about, 1% of a mortgage rate or 100 basis points in that rate, that equals a 10% rise or decline.
Mm-hmm.
If you're going from 3 to 6, that's a 30% reduction in property value just based on affordability of the payment.
Yeah.
That's why I think it's a little bit misleading when some of these guys think that there's always going to be this opportunity for people. There isn't going to be, because you and I lived through 07, 08, 09 when that happened, and there was a ton of property. Rates were still relatively high or ridiculous because they only wanted super overqualified buyers. That put us all in a pretty tough position because it was the mom and pops that couldn't play anymore. And from our perspective, it was, well, now that property, I know it was worth 350 2 months ago, but I've got bad news. It's only worth 250 now,
Yeah.
based on the numbers. It's just
Yeah.
math.
I think a couple of things happen immediately, because I've thought about this a lot, because I think this is the only thing that could cause a 2021 crash, of size. And again, it will be countrywide. The beauty of, I don't know, the beauty, the interesting fact is, if interest rates go from 3 to 6%, everybody hurts. Everybody.
For sure.
Everybody.
Across the board.
Across
Yep.
the board. So I think a couple of things happen. You can just play the dominoes out. First, all refis, or at least 99% of refis, stop.
Right.
Nobody's taking cash out. Nobody's doing rate and term. It's over.
Yep. Correct.
Acquisitions stop almost
Correct.
immediately.
Have to.
Actually, the only deals that get done are cash buyers, because it doesn't matter, right? So there'll be some cash deals done.
Yep.
So, and it will be a crawl. And then what happens?
Look at the deals that they'll be getting, though.
Oh,
If you're a cash buyer,
yeah.
Holy cow.
Yeah.
Like, they're going to be the prettiest girl at the dance.
Oh, they'll be the only girl at the dance. I mean, it don't matter what she looks like. It'll be the only girl at the dance.
Exactly. Yeah, exactly. And that's the scary thing is, we've all been in those markets where, what are you going to do? That number doubles and you go from 3 to 6, and all of a sudden affordability is cut in half.
Yeah. It would be ugly. So then what happens? Then inventory starts rising. We go from a ridiculous seller's market right through a balanced market. We would be in a buyer's market by day 45. I mean, it would
totally
just be
agree.
that fast.
Totally agree.
That would paralyze a lot of stuff. Frankly, a multifamily and commercial would probably feel it even worse than residential.
Of course. What about those guys that their 5 year is up?
Oh, they have to refi. Oh my God.
Yeah.
Yeah.
Think about that. Your 5 years is up. Now is your time, and you have to refinance. But the last time you locked in rate, you locked in at 3.5 or 4, and now it's 7.
Oh yeah. How about the people with mezzanine financing, the 2-year interest onlys? Oh, geez.
Oh,
yeah.
done.
Yeah.
Didn't a big deal just blow up with that?
Yeah, there was a hotel that just blew up. Mezzanine financing. They lost 7 hotels in Manhattan, Times Square, some other places, right? It's happening, folks.
It is.
So again, if interest rates go from 3 to 6 in a 30-day window, real estate crawls, inventory builds. We go right from a seller's market to a buyer's market. And that will probably take, be somewhere between 9 and 18 months to play out. And the reason I mean that is prices will have to reset. Prices are sticky on the way down, but ultimately deals will get done at 6% in some time. I mean, that's when I started 15 years ago. I was paying 6.5. So deals will get done just at a much lower price because of affordability and yield and all of that stuff. It would be painful. It would hit the economy. There is no question. Hit the economy. Hard. Real estate's a big part. Yeah, 3 to 6% is probably the scariest thing I could think of, right? It's different if it goes 3 to 6 over an 18-month period
Oh, of
versus a
course.
30-day window, right?
Yeah. But then you're still, I mean, to that end though, looking at the rate side of things, I hate to keep on going back to it, but cap rate going to 40.
Cap rate going to 40.
Excuse me, capital,
Oh,
long-term
capital.
long-term capital gains.
Right.
If that goes to 4, I mean, imagine what that then starts to look like.
Yeah,
There's
these
then no
cascade.
capital, right? There's no, exactly, cascading down. There's no capital gain there because now you're selling with a 6% rate out there instead of a 3. So your property's down significantly. You're lucky if you're not writing a check at the closing table or
Well,
short.
yeah, or you could just, yeah, then you could write it off on your taxes as a loss.
Sure. And not the kind of loss I'm looking for.
Yeah, I don't want that loss. That's a bad loss, Michael. Yeah. So at the end of the day, an interest rate spike all of a sudden would be very, very bad for real estate. Ultimately, it would probably slow us down as well because we would be picking for inventory. You know who the one winner is in an environment like that, I think? It's the people who can buy subject to creative financing, because there will be some loans on properties that you're like, hey, you've got a 30-year loan at 2.85%. You need to move to Texas for a job or whatever. I'm going to take your property over subject to because I know I could rent for positive cash flow and I'll let prices come back. Right. I think that's the one winner.
I think there's that one. I think there's also the side of I think there's also the corporate side, right?
Oh,
Where if you've got literally a fund with $1 billion,
yeah,
and all it's doing is sitting there on the sidelines right now, right?
Mm-hmm.
That's what it's doing. That's what some of those SPACs are doing. It's just money sitting there on the sidelines, waiting to deploy capital to either bring a company public. But if you all of a sudden look at it and say, yeah, well, we're not going to be signing up for 6%. We're cash.
Right. Exactly. Yeah.
That's going to put corporate back in buying homes again.
Yeah.
You know?
Absolutely. So again, the winners of Wall Street. Yay, the rich get richer. Not cool. Right. All right, man. This has been a lot of fun. I can't wait for topic number 4.
Awesome. Appreciate it, Mike.